It's kind of wild when you think about it, right? A bunch of people have a meeting in a single room in Washington, D.C., and suddenly the price of a decentralized asset like Bitcoin goes on a roller coaster ride. It seems like those two things shouldn't even be connected, but as we're about to see, they absolutely are.
So, what's the real deal here? How does a small group of economists in a boardroom seem to hold the keys to a global, supposedly independent financial network? Well, the answer, as it often does, is found by following the money. So let's connect those dots. Here's how we're going to break it all down. First, we'll look at the Fed's one huge lever. Then, we'll see how that lever controls a global tap of money. After that, we'll see why crypto is the ultimate destination for that money when risk is on. We'll also talk about why this relationship isn't always perfect. And finally, we'll give you your own dashboard to track all of this yourself. All right, first up, the Fed's big lever. This is the main tool. It's the one thing that has the power to move not just the American economy, but pretty much every market around the world. And that lever is called the federal funds rate. Now, it sounds super technical, but the idea is actually pretty simple. It's just the interest rate banks charge each other for super short-term loans. But because it's the base rate for banks, it becomes the foundation for everything else. We're talking credit cards, mortgages, car loans, you name it. It is literally the bedrock cost of money. So the Fed can basically pull this lever in two directions. When they hike rates, that's called tightening. Money gets more expensive to borrow, which is great for fighting inflation, but it's usually bad news for investments that have a lot of risk. Then you have the other side, rate cuts or easing. This makes money super cheap, gets people and businesses spending, and it's basically a massive green light for those very same risk assets. This push and pull, this is what makes the markets go round. Okay, so how does this one lever in the US create these massive waves all over the world? Well, that brings us to the global liquidity tap. You can think of the Fed's decisions as controlling a giant faucet that can either flood the world with cash or, drain it dry. And here's how that works, step by step. The Fed cuts rates. Suddenly, borrowing is cheap for everybody. This causes global liquidity to expand. There's just more cash sloshing around the financial system. So what do investors do when they're sitting on a pile of cheap cash? They go hunting. They start looking for assets that can give them much better returns. And that hunt for yield leads them straight to assets like crypto. You got to remember, crypto absolutely thrives when money is easy to get. When safe investments like bonds are paying almost nothing, investors have to get a little more adventurous. They become more willing to speculate, and that makes assets like crypto look incredibly tempting. So yeah, where does all this fresh, cheap money end up flowing? That takes us right to our next point, crypto as the ultimate risk-on asset. To really get what drives crypto's price, you have to understand this idea of risk-on versus risk-off. It's simple. When investors are feeling good, confident, and money is cheap, they pile into risk-on assets, things like tech stocks and, yes, crypto. But when fear kicks in and money gets expensive, they run for the hills. They flee to risk-off safety plays like government bonds. In this world, Bitcoin acts way more like a high-growth tech stock than it does digital gold. And if you think that's just a theory, check out this number. The data is just staggering. Over the long run, the correlation between Bitcoin and global liquidity is 0.94. Now, for perspective, a perfect correlation is 1. So 0.94 is about as close to a perfect relationship as you can get in finance. It's powerful, powerful proof that as the world's money supply goes up, Bitcoin's price has historically gone right along with it. And this chart just makes that number impossible to ignore. I mean, look at it. The green line is the Fed's total assets. That's basically a picture of how much money they're printing. The blue area is the price of Bitcoin. You can see clear as day how the moment the Fed's balance sheet explodes in 2020, it's followed almost immediately by Bitcoin's biggest bull run ever. The picture tells the whole story. But, and this is a big but, it's not always that clean. If it were, we'd all be rich, right? This brings us to a really important point. This is an imperfect relationship. The rule isn't exactly set in stone. So here's the twist. Remember that mind-blowing 0.94 long-term correlation? Well, watch what happens when we zoom way in. If you look at it over shorter 6-month periods, that correlation absolutely collapses all the way down to just 0.36. That's a much weaker link, and it tells us that in the short term, other things can totally take over and drive the price. So what are these other forces? Well, they're the things that are unique to the crypto world itself. We're talking about huge exchange blowups like FTX that had zero to do with interest rates, but it crashed the market. Or big regulatory news, huge flows of cash into new ETFs, major tech upgrades, even just a powerful story or narrative that grabs the market's attention. Any of these things can temporarily make the Fed's influence seem like old news. So, with all that in mind, how can you keep an eye on these big picture forces yourself? Let's build out your own little macro dashboard with the exact indicators the pros use to see which way the liquidity winds are blowing. All right, first up, you want to watch the global M2 growth rate. That's just a fancy way of measuring the total money supply. Is it growing or shrinking? Next, the US dollar index, or the DXY. A really strong dollar tends to suck money out of other assets, which tightens things up. You should also watch the balance sheets of the big central banks, especially the Fed. Are they printing money or are they pulling back? And finally, Treasury yields. They are a fantastic real-time signal for what the market is thinking about the future. Look, if you walk away with just one thing today, I want it to be this simple chain of command. The Fed moves rates, that changes global liquidity, that liquidity level determines how much risk investors are willing to take. And that risk appetite is one of the biggest drivers of crypto prices. That's the whole story, right there. And all of this leaves us with one giant, lingering question for the future. As crypto gets bigger, as more serious institutional money comes into the space, will it always be tied to the Fed's every move? Or will it finally mature enough to decouple and truly forge its own path? That right there is the multi-trillion-dollar question everyone in this space is trying to answer.